Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right. Welcome, everyone. You are listening to Your Money Momentum. My name is Tom Kennedy, and I have Kevin Curley here. Kevin, what's going on?
Just living the dream, Tom.
Summer is here.
It's hot already.
Here comes June. So let's jump into it and do our month-end podcast and start where we usually do.
Bringing you a look at the past month and what may come, here's the latest financial update.
How'd May end up?
May was, more or less uneventful. It, like previous parts of the year, it was kind of quiet. But if you look just at the indices, the NASDAQ did basically slightly down, growth for Russell 1000, Russell 2000, all of them, basically within a point, all kind of slightly negative. And then if you go and you look at year to date, the NASDAQ's up 23%. And then the month, it went up 6%. Russell 1000 was up 4%. And for the year, it's up 20%. So it's kind of a weird market right now. I know you have some thoughts, but the biggest thought I had is just last week, NVIDIA went parabolic. I mean, the thing looks like it took off on a rocket ship that Elon Musk built. It's unbelievable. So there's some wild things in markets, but most of the sectors were negative except for a few. So let's go through the details.
Yeah, well, speaking in the video, first of all, if you say the word AI on a conference call and an earnings call, your stock is just going through the roof. And that's why all these chip makers and all these stocks are ripping right now is AI. And you said NVIDIA is up 170% year to date. First 5 months of the year up 170%. And I was looking at the numbers, and someone said this and coined it. I won't take credit for it, but they're calling it the S&P 493, meaning the S&P 500. To your point, year to date is up a little over 10%. If you take out the top 7 stocks out of that, the S&P is actually flat year to date. Those top 7 stocks make up close to 30% of the overall S&P 500. So the S&P 500, for those that don't know, is not an equally weighted index. If you throw in $500, you're not having a dollar in each stock. It's cap weighted, and
it's market cap. Yeah,
those stocks are all up over 30%. I mean, you go through the number one stock is Apple, which is 7.5% of the indices, up 37%. Microsoft's up 38%, Amazon 43%, Nvidia again close to 160%, Google 40%, and Facebook 120%. You look at the top 100 stocks, it makes up 70% of.
Why is that a problem? Isn't that always what it is? I mean, isn't it always the bigger ones? The winners keep winning, and they drive the whole market with a market cap weighted index.
Well, you look at something like RSP, which is the equally weighted S&P 500. It's actually slightly down year to date because it equally weights those stocks. So, for instance, the lowest market weighting stock in the S&P 500 is Dish Network. It's got like a 0.0001% weighting and is down 53%. It's good and bad. A year like last year when the S&P was down over 20%, the equally weighted index was down half of that. But you're having that reversal right now where just there's a handful of leaders. So why that's bad is, I say that because when you look under the hood, the picture isn't as bright as you may think. I mean, it's only a handful of stocks that are driving this market. I mean, the NASDAQ last month was up.
Isn't that just 8%. Momentum? I mean, isn't that just a momentum strategy? And then market cap is by default going to be momentum because the ones that get bigger make a bigger part of the index. Until they do any rebalancing, they just keep going and going and going, and this thing runs. And look at the greatest companies of all time; they all got real big. I mean, Apple go to $5 trillion. Won't it be a huge part of the index then? So
I don't disagree with it. I'm not saying it's right or wrong having a market weight versus a market cap. I'm just saying that when you look at the whole picture, because just looking at the 10% year-to-date return on the S&P is not painting the full picture. Most stocks are actually down on a year-to-date basis. So there's something called breadth in the market, and when you don't have breadth, which we don't right now, it's just a handful of stocks. That's not a bullish momentum. So point being is that we may be overbought on a handful of these names, and we could have a rough summer.
Yeah, I think a June swoon is already going to be in the headlines no matter what happens in market. And like you said, look, it depends on what you own, right? So the NASDAQ is up more than double digits. I think it's 20 something for the year. That's phenomenal performance, but it's off of a terrible year. And meanwhile, the Dow, which has done well because it's industrial focus, is falling for the year. Now, falling lightly. Same thing with S&P is basically flat for the year, or flat for the month, sorry. You know, it's just a different month. So NASDAQ's leading the charge. These are the growth companies. These are the the wild ones. But NVIDIA and, you know, Facebook, now Meta, up over 100% for year to date is really going to drive a lot of that performance. And NASDAQ's pretty risky, but if you were buying it last year when it was selling off, you're getting rewarded right now. The multiple expansion, I think, is probably the thing anybody could be most concerned about. I think NVIDIA was at like 138 or something prior to reporting earnings, and that went down because the earnings were good, but it's still at some like crazy 50 multiple for its future earnings.
Well,
and some monster number for prices. To that end, Kathy Wood thinks NVIDIA is overvalued, which she's for those who don't remember, the leader of the ARC. So she's the one who's all about innovation, and this could not be one of the most innovative companies. And she thinks, oh, that's too rich for her blood. So I don't know.
It's speaking of NVIDIA, they just hit a market cap of $1 trillion last week for a minute, and then it sold off. But they are the fifth company to hit $1 trillion in market cap after Apple, Microsoft, Google, and Amazon. And it's because of this artificial intelligence, Chat GPT. It's all fueling this, which you could argue is a mini bubbling up in some of these tech names that are in this AI race right now. Think back to 2001.
So the argument they made on the call is every semiconductor chip and everything is going to have to be replaced, and they're the only ones who currently sell those chips. So nobody else can do it. So they have a monopoly on a chip that everybody's going to have to buy, which is a nice monopoly to have. It probably won't last, but today they're the only game in town.
Well, I think WorldCom thought the same. Look what happened with them. But
well, let's equities are fun, but we're kind of burying the lead here. We got a deal on the debt ceiling.
You caught me in a bad mood today. I'm really bitter. I don't know why. The world's going to an end. Debt ceiling.
Well, this will help you with your ending of the world. So they did strike a deal over the past weekend, kind of into last week. We had a little relief rally on Thursday and Friday. Markets were up a couple percent, which is good. Got positive, but the biggest move is the 1-month Treasury bill, 50 basis points in 2 days on that debt ceiling news. Now, the House passed it yesterday. I'll assume that the Senate will pass it as well. The rumor is that as soon as it actually gets passed by both parties and signed by the White House, the Treasury plans to auction 700 bills, $700 billion worth of bills. And that had, I think, the move in 1-month T-bills causing that. If you're going to put all that liquidity out there or all that inventory out there, yields are going to drop, and they did. The rest of the market, as far as treasuries went, down 10, 13 basis points. So it is a decrease in yields, but the 1 month, 50 basis point in 48 hours that's a huge move for short rates.
Yeah, and just so our listeners can understand what you're talking about as far as putting more inventory out there in bonds, like anything else. Now you have more supply, you have the same amount of demand, so prices should go up and yields should go down. So that's why you're seeing these moves on the treasuries. Speaking of which, can you believe at one point we were not in debt? We were actually running a surplus as a country, and it wasn't that long ago. Early 2000s.
When was this? They were. I don't know if I know we were probably a little too young to quote remember it, but did you know that they retired the 30-year Treasury bond at one point in the 90s?
Yeah, I did.
It just didn't get issued.
And you know what? They didn't issue it because there was no issuance, because they didn't need any money, the government, because they were running a surplus. So Ben Bernanke, in his newest book, 21st century monetary policy, it's actually a really good read, was making the case, one of the reasons why we had the '08 crisis and the inflated housing prices is because that was the safe asset back in the 90s and early 2000s was home prices, because there was a lack of investable assets, i.e. treasuries, to invest in at that time, which I had no idea of. So he was making the case that
That's
there
an
was
interesting
a
thread to
ton
pull
of
on.
money going into the housing market, because the housing market just went straight up for the longest time, and it was pretty consistent. So, but we at one point we did not need to issue treasuries because we didn't need any capital. We had a surplus, which was really interesting. And now we're at 31 trillion and counting, which will be a good segue into headlines.
Leaving no stone unturned, it's time for headlines and the news you may have missed.
Let's start with Druckenmiller. If you want to talk about Armageddon, if you want to start with Stanley Druckenmiller and his comments on the federal budget.
Yeah, he said what we all know. If you don't reform Medicare, Social Security, and you continue to increase this debt, the interest expense and those two entitlement programs will be the entire budget. And it won't just be the entire budget, it'll be more than what the current budget is. So you're going to go from it being, we're not going to have $1 to spend on defense or any other programs because it's going to take up everything. And let's remember the baby boomers are the largest generation. And as they all retire, which they are now, and they're pretty far into that retirement as far as number of people who are retiring, those demands are only going one direction. And he kind of made it clear that unless you fix those problems or raise revenues in some significant way, this does eventually come to a head.
By the way, let's put some numbers behind what he said. He said that if you look at the total liabilities, I don't know why you're tiptoeing around this number, 200 trillion is our actual debt that we have as a country. When you factor in Medicare, Medicaid, Social Security, for all the senior citizens that are out there, $200 trillion versus our current deficit of 31 trillion today. Those are scary numbers. So, with all that said, though, he doesn't think we're going to a 2008, but he does see a hard landing amongst others like Gunlack and who's the cat over at JP Morgan, Mike Wilson. I mean, they're all pretty negative.
He's Morgan Stanley, but yeah.
Morgan Stanley, right. So it's interesting when you look at the debt, and it's a big issue, and there needs to be austerity at the end of the day. Like you said, you need to cut back benefits. You just can't. It's too hard to grow.
The problem is, yeah, it is. It has to be benefits changing because the revenues, it's going to be impossible. I've heard people talk about, hey, what if we just raised rates on tax to 70%? Well, if you look back at history, every time you raise tax rates like that, revenue actually declines. It's when you cut rates, revenue increases. So I don't really know what their solution is because it's not going to be from the revenue side of we're just going to tax more. They can come up with new tax like a VAT tax or a financial transaction tax like Bernie Sanders pitched to pay for Medicare for all. But the spending has got to stop. I mean, it's all there is to it.
It's bad. And Bill Gross said it best. And he said this 10 years ago when the debt was a fifth of what it is now. There's only two ways out of this. You either inflate or default. And either one of those are terrible scenarios. It's going to be very hard. And the third option is to grow ourselves out of it. And we're going to need some serious.
I think that's possible. I mean, I think, if you look at what Trump said for his tax stuff, his whole thing was growth. And whether we're going to get there or not, but he said we can juice the economy above 4%. It solves a lot of these problems, which is, I think, what everybody says at the gambling table or, why they can't pay their bills as much. Well, if I could just make a little bit more money, I wouldn't have this problem. And that's true, but you got to do that. So on inflation, CPI came in at 4.9% and PPI at 2.3%. And meanwhile, we're all expecting a recession anytime. The jobless claims finally got over 250,000, which is a key number. We'll see what the monthly jobs number report is on Friday, probably when this episode gets released. But the other comment on inflation is that the I bonds, which were all the rage a year ago, because they were yielding 9.6%, they went down to 6.9%. Now they're at 4.3%. So reinvestment risk is one thing to consider there. Just to remember, the other part is inflation doesn't stay high forever. Tom, comments on inflation?
Yeah, no, good point. Well, our boy Nicky T, I always butcher his last name. The AK, the Fed Whisperer, and he has no idea who Kevin is, by the way. Just so we're all clear. Just tweeted.
One day I'm going to see him at an airport. I'm going to get a picture with him.
He's going to put his head down and run away. He just tweeted this morning the probabilities of a Fed hike in June, which a month ago we thought wasn't even a question that they were going to hike, but uh, the probabilities that they hike right now is 29.6%. To put that in perspective, a week ago it was 51%. It was actually higher, and 1 month ago it was actually 27%. So, and there's a 70% chance that they don't. That 70% chance 1 week ago was at 48%. So it's moving quite a bit, and it was at 67% to start the month. I've never seen it move like this quickly, and I just, at the end of the day, I think people are making bets on either side as hedging mechanisms, which is why these rates are fluctuating as much as they are. But it's pretty
Yeah,
interesting.
I think that the reason is that they have all the people who are in the Fed talking, and they're all saying different things. So they're still consistently saying they're focused on the fight against inflation. And I think we're all hoping that they'll pause, but I don't think they will. The labor market is still tight. It seems like maybe it's starting to crack. We'll find out Friday for sure. But inflation's high, and they need to address it. And their only tool they have been using is raising rates. So I think they have to keep going. Otherwise, they have to do what we talked about last summer, which is, saying, 4% is the new 2%, and we succeeded and we're done, mission accomplished. So I don't think that's going to happen.
Yeah, speaking of talking, here's a little fun fact. Do you know when the Fed started jawboning or started giving guidance on their rate projections? I'll tell you
That's
because
pretty recent.
I read the book. I'm telling you, Ben Bernanke's new book. It's awesome. But it was Alan Greenspan. August 2003 was the first time that he gave some kind of forward guidance, and they figured out quickly that they could talk the market into where they wanted interest rates to be without actually having to move rates. So I thought that was pretty interesting.
Yeah, I think they've used a lot of tools, but it used to be a more secretive organization, and it's always had some independence. I think, to the comments about Stanley Druckenmiller as well as the inflation issue, a lot of this comes from the fiscal side. Obviously the entitlement programs, this is the fiscal side, and the Fed is monetary policy. So doing something totally different, but it's heavily influenced by that. And I don't know, to do more fun facts, who was the first president to actually use the fiscal side to juice the economy?
I am going to say, that's a good one. Arthur Brown?
So this is the president of the United States.
Oh,
It was around then, but it was just before that. JFK was the one who had that new idea, which was ultimately carried out by Lyndon Baines Johnson. But Reagan was the one who masterfully used it most effectively, but he was the third guy to use it, where he passed a bill where the day after he got his reelection, rolled back all the things that he had done to juice the economy to get reelected. And I think there's probably going to be a lot of that. So this year, equities are up, things are kind of going up. I think they'll attempt to try to keep juicing it until the next election, and then right after that might be when we get kind of hard landing to deal with some of these problems.
God, it must have been nice to be back in the day when you actually believed in Washington and who your president was. I can't imagine what that period must have been like.
What day was that? When was that?
I don't know. Any time before maybe 2000.
I don't think that time existed. So
No, you don't think it existed?
If you read a couple of the history books, there were fights in the Congress. Obviously we had the Civil War. That was pretty big division time. I think there's a thing about the decorum more recently has gotten worse for sure. But
yeah.
All right. So a couple other headlines to discuss. The G7 has met. Biden actually flew over there for the meeting. They announced more Russian sanctions in response to some of that. At part of those meetings at the same time, China decided to ban Micron, which is an American semiconductor company, from having their chips go there. Any thoughts on the G7, Tom?
That was really interesting. And by the way, when they decided the whole Micron debacle was a day after the G7, when they announced the CHIPS Act, that they were going to dump in $52 billion. And they're really all making a push to block China out of this stronghold and their non-market, procedures and processes. So China's response was to go after a single stock because they, quote, failed it. I think their network security review failed, from what I read. I don't even know what that means. But
they could have just released and said, "We decided to do this."
Yeah, I think it just made it worse. But No, it'll be interesting. I mean, this isn't new news. I mean, they've been doing this, which is why a lot of people want to stay out of China as far as investments go. Like like your buddy up there, Kyle Bass, who's your next door neighbor, absolutely hates China and has been shorting China for the last 15 years. He'll get it right eventually.
He's got some good points on it though.
He does.
It's not a great place to live. Yeah, I think the biggest takeaway from the G7 is that it still matters. They're 40% of global GDP. It's 7 countries that really kind of dominate, and for better or worse, they all move together. Now they might be cajoled by the biggest member, but if you look at India and China and the other ones, they are taking a bigger share than they used to. But the G7 is still running the world. So these meetings do matter. The takeaways, the impacts, the decisions made do have big effects on the markets. So, all right, let's move on. We'll save the Bank of England for mid-month when we do our central bank roundup. I've got some follow-up from college conversations we had last month. So, I'm sure everybody is excited to be done and start their working career for the next 30 or 40 years. The Wall Street Journal had an article where they worked with a couple different organizations to do research on, really the value of college degree and what do people make after they graduate from college. So what are the average salaries based on major for the first 10 years out of college? And then they looked and said, well, what colleges, the famous ones that we think are the good ones, what's the premium over that? So I'll just run through these, and I think it'd actually be fun for you to guess. So I might ask you a couple of these. But when I was in college, the safest major that I was told to go get, which I didn't choose to do because I wasn't interested, was accounting. It said you're guaranteed to always have a job. Big 4 firms pay well. You stay on that partnership track, you're gonna have a great life. What do you think the average salary earned over the first 10 years is for an accounting major?
What it's been over the last 10 years or the next 10 years?
The next 10.
The next 10. I would say, geez, I don't even know. Maybe, I think I'm going to be high on this, but maybe 95.
So 67,000.
Yeah.
If you went to one of the top colleges, so they had a top 10 for private schools as well as public schools, and they're all the names you expect. For all these majors, the premium by going to one of those colleges was 30 or 40% higher. So if you went to one of the top schools for accounting, you're making $100,000 over your first 10 years of your career on average instead of 67. Now, a few of these are kind of jump out at you because one of the highest ones on here was data science. So I don't remember that being a major, and I didn't graduate from college that long ago. It's only 14, 15 years. So, $100,000 you can make in a data science. Now, the other job that I was always told will never run out of need is engineers. What do you think engineers are making?
I think that one is going to be the widest gap. I would think because there's multiple different levels of engineers, but I would say definitely the six figures. I would say low 110, 115.
So the average was 90,000. And then again, top colleges, you're at 120, 130, that type of thing. They had a major they called tech, which I don't know what that means. Maybe that's STEM jobs, maybe it's something like that, but 106,000 for that. And then the top schools, people making 148. So pretty impressive. Now, the other two, which I was surprised about, management consulting and law. So law, obviously, this is a law degree. It's a little different, but management consulting, Tom, these are the ones that are supposed to be the high-flying McKinsey types, Bain, that go around and tell you how to run your business. What do you think the average is for those folks?
75.
So 94. And then top school, you're at 120, 130. So, these numbers kind of seem high and kind of don't. It's hard to say. I don't know.
Do you get to work from home? What's the new work life like?
I have no idea what the rule is. So
how much free
finance,
stuff do you
96K, marketing, 93K, software developer was 103,000. If you go to law school, on average for your first 10 years afterwards, you're going to make 112,000. If you went to a top law school, you get into the mid 150s, which
seems low to me.
But
wow.
That seems low to me too. I think the top firms are paying well in excess of that. So you got to remember this is an average, and they're scraping not public data, but they worked with 3 different data sources, one of which was Glassdoor, and then they named 2 others, and that's how they compiled it all. But it's, if you're graduating from high school and you're going into a career and you compare it to what these majors have graduating from college, I think it's clear college still has a tremendous value. And then if you're considering a top college versus, you're kind of the run-of-the-mill school, your school down the street type of thing, there is a premium, 30 to 40% more in salary for your first 10 years. And I'm guessing that those people get in line for promotions as they're well paid too. So it continues to compound as getting those top degrees as far as the major top colleges. I think it does make a difference. So,
Well, college is no longer free starting August. They're going to start repaying back student loans, which is great news. I'm very happy
fix
about
that
that, by the
entitlement
way.
problem, huh?
Yeah, it's not even about the money; it's the entitlement problem. So that made me happy this morning.
Get your future freezing cold takes as we launch into our latest series of Bold Predictions.
So we like to wrap with bold predictions. I've got two kind of lead-ins, and you can tell me what you think on these. So recently in May, a 1,100-year-old Hebrew Bible sold for $38.1 million. So you can do a bold prediction on some book that you think might crack that. I don't know if it can be. The other one was on May 4th, the Wall Street Journal cover page was astronomers watched a star eat a planet that was 15,000 light years away and say this, then a little footnote there. Yeah, this will eventually happen to Earth too. So go wherever you want. Bold predictions on books, bold predictions on the universe, Tom.
I'll start with the books, but I'll talk about arts and antiques because I was just looking at this with the client. You talk about recession. Some people aren't feeling it at whatsoever. Arts and antiques world, I don't know what that's comprised of. I don't know if that Bible falls in that category. I would think it's an antique. Did 67 billion in revenue last year, which was up almost 10% year over year. 45% of that was from the US. So, and I don't know, I mean, I keep hearing about baseball cards and collectible items that are just continuing to hit record levels. So it doesn't really surprise me that someone would spend 38 million on a Bible. I don't know anything that could top it.
I don't
as
know
far
how
as the
many
book
of them
goes.
there are. I mean, I think there's like 10 or 15 of these. So
Yeah.
to have that is something. I don't know if they just kind of display it somewhere or if they actually look through it or what. But it's
So-
quite. I mean, didn't the Constitution? Wasn't that like 2 years ago? They sold one of those for. I think the guy from Citadel is the one who bought it, but it was
Ken Griffin. Yeah.
Yeah, didn't he pay? I
Yeah.
want to say it was like 60 million for the Constitution or something. And that's.
I don't know. I think if I had the money, I don't think that would be the first thing I'd buy personally.
No.
But
well, he bought everything else, so he was moving on.
So what was the Time magazine? I wish I could. I know there's stats on
It's
this.
wild.
It's almost like you have like a 90% chance to be right if you fade Time magazine covers. Like going back to like the gold standard. I'm not even kidding. And I couldn't find the numbers in Time and the stats on it. But when the Time magazine comes out, whether it's Bitcoin or the dollar or housing prices, it just goes the other way almost like clockwork every time. What was the most recent Time magazine?
Yeah, that one was wheat, and that was the cover of The Economist. So magazine covers are a good thing to look at.
Were you just talking about it in
was,
general, for The Economist? And I know the Time.
So The Economist had a cover. They had the plant wheat on the cover, and we're talking about the coming food catastrophe, the week that Russia invaded Ukraine last spring, and that was the top tick. So just under $1,300 a bushel, and that thing has just gone.
I bet wheat as we speak is probably down to 700. That's that article has been published.
Yeah, it is. It's way down. So, good. Well, that's all I've got from May. Anything else you want to throw in there?
Yeah, let's just end with real quick real estate. I know we've kind of beat this to death and the regional banks, but let's just talk quickly about home prices. I mean, you're starting to see them drop. They're still highly elevated from where they were, but home sales dropped 23% on the year. Prices were down 1.7 for the existing median homes. But I think it's like we've talked about before. It's geographical. There's certain states that are feeling it more than others, like San Francisco and California in general, versus Texas is still booming. It's where the jobs are. So I think you'll continue to see them go up in certain areas, but it's just unsustainable, the amount of growth that we had. But I think the biggest concern that most are afraid of right now is that the regional banks own, and this goes more into the commercial real estate market, 43% of the loans in the commercial real estate market are through these small regional banks, 40% of which is through office space. And that's been the big debate right now is commercial real estate in for a whole lot of pain, and in response, or the regional bank's going to take it on the chin because of it.
Yeah, so on the residential side, the number I saw was that home sales dropped 23% year over year, which is a huge drop as far as number of homes sold. But I have a really good reason why. There's 32 million mortgages out there, and there's 32 million mortgages are below 4% interest rate. So why would you switch homes if you're on that? There's 10 million that are between 4 and 5%. There's 6 million mortgages between 5 and 7. Only 1 million are over 7%, which is where I think today, if you looked it up, it's probably 6.91 on the 30-year fixed. So basically, that's a 7% mortgage. When you have almost the entire mortgage market is below 7%, you'd have to sell and buy. You're going to have a crater in the number of home sales. And, at the moment, prices are only down slightly, 1.7%. And that's all, existing home stuff. So this doesn't take into account new homes, which could be happening. And to your point on commercial real estate, I put in the document that we're going off our outline. Is it quietly crashing? So in some of it, like you said, the regional banks are holding that, but foot traffic is down 25% in downtown commercial districts versus April of 2019. And office space in downtown commercial districts is 50% occupied. So
yeah,
unless everybody's going back to the office, which I think there's a lot of resistance to, you're going to have to reprice all of it.
Yep. What do they call it? The Great Resignation. I don't think it'll ever go back to where it's at. It might come back a little bit, but I think the office space is going to be in some trouble. And I'll end with Blackstone. I just saw a tweet earlier today about Blackstone. I think it's its seventh month in a row where they're have their guards up for withdrawals. And Blackstone's the biggest private real estate shop in town.
Thing?
The gatekeeping, yeah. But people,
is that the BREIT?
The BREIT, they requested $4.3 billion last month in withdrawals, and they allowed $1.2 billion. Don't quote me on those numbers. It was a tweet. I haven't verified it, but 7 months in a row where they had gates up where you can't get your money out, because a lot of those assets are invested in office, and they're getting killed right now, and they don't want to lock in those losses or mark to mark, which is even worse. It's probably a lot lower than they lead it to be, but that's another conversation.
Yeah, it's interesting because last year when they started the gatekeeping, they were up when everything else was down, and people were trying to sell that fund in order to buy stuff that had fallen in value. And now it's maybe they're falling in value and they're gatekeeping for that reason. So
yeah,
either way, not as liquid as it was originally offered to be.
Well, good. Well, that wraps up our month-end podcast. We'll be back in 2 weeks with our mid-month review. Thanks, Kevin.
All right, see you later, Tom.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.